But in general, everyone's looking for growth and retention as the most important metrics, but it's kind of always been the same rubric for what makes a good SaaS business. For the first time this year, things changed, and they changed so quickly. I've never had conversations like this. We would talk to leading private equity firms, call it February 1st. Our criteria has changed a lot. It's X. And then the next week, it's X plus Y, and then it's X plus Y plus Z. The first big change we've seen is the maniacal focus on gross retention. The gross revenue retention metric is really you don't get credit for upsides, but you get dinged for downsells with no credit for upside. So basically, if you can't upsell anymore, what's going to happen to your business? And this has become so important. Largely, they want a number around 90%. And our read of that is it's a little bit of a proxy for we don't really understand the AI threat yet, but we know if a business has 90% plus on the gross retention, it's probably pretty resilient, and we can take some hits on the AI side and still survive. The other thing I would say is system of record has become more important. Things that are more point solution-like feel like they could be at further risk from AI versus if you're a system of record. What buyers would like to see is system of record where there's either a data moat, so proprietary data, or a payments opportunity. Businesses that have payments are a little bit more resistant, and that's viewed as kind of a moat around AI. And if it's not agentic, if your business started 8 years ago, it's kind of hard for it to be fully agentic. You need to work towards agentic, or at least have the ability to hang agents off the backbone of your software to provide value.
Hey, everybody. Welcome to the Practical Founders Podcast, where every week we hear an amazing story from a serious founder who built a valuable software company and did it without big funding. I'm your host, Greg Head, and this week my guest is Mike Lyon, the founder and managing director of VistaPoint Advisors. VistaPoint Advisors is an M&A investment bank for bootstrapped, founder-led software companies that have 3, 5, 10, 20, up to 50 million in revenue, so the lower mid-market. They only help founders on the sell side to shop their businesses to all those buyers out there, strategic buyers, private equity buyers of all types. He's been doing investment banking for over 30 years, and VistaPoint for 15 years has helped over 150 founders sell their companies. So today we talk about what's going on in that game, especially in the middle of 2026. What has changed this year in the M&A game, selling your company as a bootstrapped and lightly funded software founder in the AI game? We go through all the details of what the core principles are that buyers are looking for, and what is changing literally this month, and how is that going? Still very active out there, but the game is changing right before our eyes. He's talking to a lot of buyers out there, but only represents founders. So it's an expert interview with Mike Lyon. Hey, Mike, good to see you. Welcome to the Practical Founders Podcast.
Hi, Greg. Thanks for having me on.
I look forward to talking to you today about everything that's changing in the world. Maybe not everything, because almost everything is changing. We won't be able to get to that today. But what's changing in the world of selling your SaaS, AI-enabled SaaS company this year, 2026? So welcome to the podcast. I've been listening to some of your useful podcasts that you're putting out there. Appreciate all your content out there.
Thank you. Absolutely. Definitely a lot to talk about. A lot changing this year, more than any other, probably.
Well, and the fun we have is I'm focused on practical founders, bootstrap, lightly funded SaaS, AI-enabled, that are $1 million, $5 million, $10 million, $20 million in revenue, which is very different than the big sport of public companies, big VC funding, all that, the stuff we read about in the headlines. You're also focused on the bootstrap founders, software founders over there. And it's a different game. Let's say
Absolutely.
Down here where all the action is, to be honest. But how long have you been focused on bootstrap SaaS founders?
So we started VistaPoint almost 16 years ago, and the idea was to focus on founder-led, at the time, SaaS businesses, but now SaaS and AI and tech-enabled services.
Yeah. So it was just SaaS. And why was it, and did you also represent VC-funded software companies who were trying to sell?
We did not. And the premise for starting VistaPoint was really trying to solve conflict of interest we saw in the marketplace.
Hmm.
So my background, I was a chemical engineer out of undergrad, worked for Exxon and BP. I lived through the big ExxonMobil merger, which at the time was a
Oh,
huge
yeah.
merger, not so much now. And then I ended up at Citigroup. My first day of grad school was actually 9/11. So getting a summer
Yes.
internship
Oh.
that year was pretty difficult. So I ended up at Citigroup. And so I showed up at the end of the tech boom when basically Wall Street was getting sued by the feds over all these conflicts of interest around research analysts taking tech
Oh,
companies
right.
public.
I remember playing that game. Right.
Yeah.
You
Yeah.
could have the research analysts of the bankers that took you public say nice things. Yes.
Absolutely. And I remember some of the bankers I worked with showing me the initiating coverage reports they wrote for the research analyst. So this is the banker who's, taking the
Mhm.
company public, supposedly writing the research for, the buy side, which obviously was a big no-no. So I came into that world just seeing all these conflicts because they were being talked about constantly. Like Citigroup had hired Chuck Prince to run the business, who was a lawyer, and his whole goal for the next 3 or 4 years was to settle all this litigation.
Uh,
So you just see conflicts everywhere. And the one that I saw the most was, at a bank like Citigroup, we have all these big clients, big private equity firms, big strategic companies, and they might pay our group, $15, $20 million a year for all the deals we did for them. Yet when we were running a sell side process, if they were interested, it made things really awkward for the banker because if, for example, IBM really wanted to buy the company, what do you do when you're the banker who, IBM pays you a lot of money? And so I thought the world was going to change where software companies were going to raise less money because of things like SaaS, right? And you could go to
mhm.
AWS, not build your
Yeah,
own
yeah. It's
servers.
efficient. Yeah.
And I thought I wanted to be on the side of the founders, which would be the scarce resource. So basically, we tend to work only for founder-led businesses. Maybe they've raised $3 to $5 million, but not
Yeah.
from a
Practical.
really notable VC. So
And
that's kind of our
what is
model and focus.
that's my practical distinction, right? They're not on the full drugs yet because it changes the game materially. But how would you describe what that line is between practical and impractical?
I think it has to do with a couple of different elements. One is the need to continually raise capital. So if you think about a VC's interest, right, they invest in a lot of companies. Most of them don't work, but some of them do really well.
Yeah, of
And they
course.
would like to
Yeah.
own as much of that company as they can. And the mechanism for that is raising more capital. So some of it is what I would call maybe not unsustainable, but the economics or the unit economics that require you to keep raising capital.
Yeah.
And then the other element is the control, which is what we really look for. So we want to know we're working for the founder, not for an investor, because that's our whole story around conflict, right? We want to be working for the founder.
And you came out of the big companies and then the big M&A, and you went all the way to, just past startup, right,
Right.
into the factories running. You're not selling 50, 100, $300 million software companies. You're selling the 3, 5, 10, $20 million software companies. That's a long way. Why did you go all the way to the small and scrappier zone?
Yeah, I think part of it is one of the things we recognize is that for businesses that are 3 to call it 50 million in ARR,
Yeah,
that are founder led, usually one thing exists in that business, which is fantastic product market fit. So
right.
the reason why our types of companies are growing is because they have a really good product. Usually they have some affiliation with the industry that allowed them to see that issue. But what they're not particularly good at, frankly, because they don't have the capital, is scaling sales and marketing. And that is a problem that both strategic buyers and frankly private equity investors can help solve. So we just thought there was a big opportunity. There was a lot of innovation. And again, I just thought companies weren't going to have to raise as much money. And I thought that was a more interesting part of the market than maybe a $100 million ARR business who has everything figured out. And it's a little bit more, frankly, of financial engineering.
Yeah,
So PE firm puts debt on it, kind of
yeah,
pays the debt off and gets the return.
yeah. And you talk about representing founders only. So that's the sell side, represent the sellers, not the buy side. Is this really a problem in M&A for practical founders that you have M&A bankers like yourself, I don't know if you call yourself an investment bank, a boutique investment bank, that have conflicts of interest, that they're representing founders and they're also representing some of the buyers, I guess, out there and play
Yeah,
a game?
I think I can answer that by what would happen to us early on. So when we first started the bank, we're representing all these interesting SaaS businesses that are growing very quickly. And particularly for private equity firms, there's a lot of repeat transactions. And so early on, before everyone kind of knew our model, we'd be representing a really attractive company. Private equity firm A would call, say, hey, we really like this one. We'd like to win. That's great. You like hearing that as a banker.
Mhm.
But then they would say things like, if we win, we're selling 3 portfolio companies next quarter. We think you'd be a great fit if we win.
Ah,
Or we promise we'll hire you to sell the company when we sell it if we win. And so the private equity firms have lots of leverage over bankers in this
ah,
area. And so the only way to really avoid that is to not do it and make it
mhm.
clear that you're never going to try and sell their companies. And, our relationship with private equity firms is solely based on quality assets we bring to the market,
Yeah,
not
yeah,
horse trading.
yeah. Okay, got it. And you and your team have been doing this for over 15 years. Tell us about the kinds of software companies you've represented, and then we'll talk about your team and how you go about it.
Yeah, absolutely. So we tend to focus on vertically oriented software. Not a big surprise there because typically if it's vertically oriented, you raise less capital, right? If
Yes.
you're chasing down Salesforce and it's a sales and marketing game, you're going to raise hundreds of millions of dollars to largely go compete on sales and marketing, maybe not even so much on the product. So
Yeah.
we tend to focus on vertically oriented software. Those are the markets where you can build a big enough business to kind of have a good exit to a private equity firm, but not be such a big total addressable market that every VC in the country is kind of chasing down that market. So we do a lot in education, we do a lot in corporate training, compliance, real estate. Basically, if it's a vertically oriented market, that's where we focus on. The enterprise values of the businesses we work with tend to be in the 30 to $300 million range. The reason why there's a cap there is usually once you've reached 300 million in EV, you've either sold the business or you've done a recap where one of those 70 private equity investors that are calling you now owns a majority. And as I said earlier, we don't ever want to work for those guys because we want to be able to negotiate against them well. And so that tends to be our natural range.
Great. So I know you've done a lot of deals and we've had plenty of conversations. You're very savvy about all of this, what's going on. You got your finger on the pulse. But you also have a team that you work with. Is it, are they running the deals or are you running the deals or how are you involved in all of this?
Yeah, great. It's a great question. We're fortunate enough that we have 5 other MDs at the firm, and we've been around 15 years. On average, they've been here about 13 and a half to 14 years. So they kind of came in the model, grew up in the model, understand the model. And we've chosen to do that because, frankly, it's hard to break that conflict of interest with a traditional MD who that's been their whole career is kind of
Right.
horse
Their
trading.
DNA is wired to horse trade. Yeah.
That's right. So that's just how they've grown up understanding banking. So the way we work is we have different pods. So each MD leads a pod, and they tend to be focused on the blocking and tackling of a transaction up front. So building the marketing materials. We'll probably get into this later, but a ton of work in cleanup,
Yeah.
revenue by customer cube, financials. I tend to be more involved in the negotiation phase and the negotiation strategy. And so I don't work on all the deals we have at the firm, but I work on a good chunk of them.
Okay, great. And well, let's talk about your ICP. Well, I could use this language with you. You know this because there's all kinds of software companies out there, and you do what, like a dozen deals a year or something like that.
That's about right. Yeah.
That's about okay. So, but like, okay, there's all these companies, and a certain number wanna. You're not saying yes to everybody who knocks on your door and wants to work with you. What is and they're shopping and comparing against other partners who could help, help them exit successfully for a premium. And you're talking like a VC. You talk to a lot of people. What is a sweet spot kind of deal for you that founders could say, "Am I in that sweet spot or not necessarily?"
Absolutely. So we tend to, not surprisingly, look at our ICP based on what's going on in the market. So for us, we want to work on deals we think we can make hyper competitive. So we tend to run something that looks a little bit more like a non-exclusive process where we're not just giving one buyer, 45 days of exclusivity. So we want assets we think will be very competitive in the marketplace, both with many private equity firms and strategic buyers, so we can run
Okay.
that competitive process. For us, that generally, and these factors can change from year to year, but generally a good growing business, so think 30 to 100% plus growth rate, ideally, although we do work on some businesses that are a little bit lower growth rate, generally high retention, so gross, net, and logo. And I think when we talk about the AI changes, we'll really dig
Yeah,
in
yeah,
on what's changed there.
yeah.
And a really good product market fit, because what founder-led businesses tend to bring to the table is really good product market fit. And then generally, you want them to be capital efficient. So most founder-led businesses, by definition, are. But it would be rare for us to work with a business that was negative 40% EBITDA margin, but growing really quickly. Those generally are not the types of businesses that our buyers want to underwrite and see a lot of value in.
Okay. And not every company is like that. So when people have a conversation, you could say, are we a fit for you? Are you a fit? This founder funding fit and the founder market fit and all this kind of stuff. And there's a fit that has to happen there. Probably even a chemistry where we say, we get your business and, you're the type of person and team I want to work with.
I think the other thing we spend a lot of time with is trying to help founders understand how their valuation might change over time. So a
Hmm.
very common thing would maybe to see a business that's $3 million in ARR, but great metrics.
Yeah.
And we might talk to them about, hey, right now, for the next 6 months, your valuation is going to increase linearly, meaning as your revenue goes up, you're roughly going to get the same revenue multiple. But there are certain points along the trajectory of a software company's life where we'd call it a nonlinear valuation increase. So sometimes
Yeah.
that's clearing a certain revenue threshold or bringing the revenue concentration down. So in those situations, we're really counseling the founder that, hey, you might go from, I'd call a middling revenue multiple to an amazing revenue multiple if you can wait another year. And I think sometimes founders don't really understand there's these discontinuities in valuation.
Yeah.
And it's our job to make sure they understand that and can make a good decision around, is it worth waiting a year? And I would say that's the most common thing, is there's some metrics that need to improve a little bit before you could get that amazing valuation.
And things like it's surprising to a lot of founders that a $3 million ARR software company is worth a smaller multiple than a 10 or 20 million. It's still early, it's still founder dependent, and there are fewer investors and buyers that want to buy something so small, right? And
That's
early.
right.
There's way
That's right.
more up market. And so you see all of those dimensions as well. So you're trying to add value to what they would do themselves or otherwise. And a lot of that is just a competitive process. You can take it out as a clean deal to a lot of buyers and get them bidding against each other. Uh, all, all practical founders get to a million or a few million, and they're getting inbound LinkedIn every day. Hey, can
Right.
we talk? Can we, buyers and investors and things like that. And then they get preemptive deals, right? We'd like to buy your company. And then their eyes go wide and it's kind
Right.
of interesting. But, a one buyer, one kind of deal isn't very high leverage for the founder. And that's a big value of the banker is, take it out and make it competitive.
I think that, and also knowing the buyer that you're dealing with. So it's not 100% correlation, but generally the more aggressive the inbound, the more value the buyer is. So if you put yourself in a buyer's shoe, if you're used to losing all deals on price because you can't bid up, what do? You get more aggressive and try and get to the company before they run a process.
Yeah.
But I won't mention their names, but there's a handful of private equity firms that are just relentless in talking to these
Oh, yeah.
founders, and
We know it.
founders get really excited about it. And then I can say, hey, on average, over
Yeah.
70 deals, these guys are a 40% discount to where the valuation typically ends up. I'm not sure I would spend that much time with them. Or party X is a 75% chance they're going to retrade you in exclusivity because that's just their strategy. So I think the challenge is there's a lot of non-public information about these buyers, and they all have a good story, right? They're very good at sales and marketing. You only kind of know who they are by dealing with them for, 10, 15, 20 years. And I think that's the advantage we have.
And see all the stuff that doesn't get talked about.
That's
In
right.
public that
And there's a
isn't,
lot of it.
there's proprietary data in here that
Right.
that the Claude and ChatGPT, as helpful
Do
as
not
they
know.
are
Yeah.
for founders to learn the M&A game, they don't see that side of it. And can you generalize about a typical process in your world founder calls. We have a lot of back and forth, and they eventually start working with you, and then you go through the cleanup and eventually start shopping it, like those kind of steps
Yeah,
generally. Because founders haven't done this before, right? Buyers have done this
absolutely.
over and over and over again. They got legal teams bigger than most of the companies. But what does the typical process look like these days?
I would say the typical process here is the first part that's really important for these types of practical founder companies is the data cleanup. And it's particularly important for the private equity buyers, maybe a little bit less important, but still important for strategic buyers. And I would say
Right.
there's a big misunderstanding amongst founders about what clean data looks like. And it really arises from the fact that if you're a founder, you kind of care about cash flow and making payroll and all those things, which is obviously what you should be focused on. But buyers don't really think that way, right? They're focused on gap metrics and retention metrics. So I would say the average company, we spend about 50 to 100 hours cleaning up the data. And half of it is just getting the data more accurate. The second half is how do we frame this data to make the retention look as good as possible, but also survive scrutiny when a buyer does diligence. The biggest mistake I see founders make is just handing raw data to buyers, and then the buyers run their own analysis and can decide what your valuation is based on their view or take on your data. So the prep phase is really important. Then we get into kind of the launch phase. I would say what we do is pretty similar to most investment banks. There's a no names teaser. We send that out, have conversations with the buyers, trying to get them to sign an NDA. And of course, you have to give the strategics a head start because private equity firms will be all over a deal once you launch it. So you kind of
Yeah.
give the strategics a head start. Then we give them the marketing materials. And then usually what we're trying to do is get to some management calls with buyers. And this is about a month into the process, focused a little bit more on strategics, but some of the better PE firms. And then we get to a first round bid. So we'll probably call it a month and a half, 2 months into the process. That's all pretty standard for banks. When we get first round bids, we're not really trying to pick a winner. We're trying to get rid of the losers. So we might narrow
Yeah.
the process down to 4 to 6 buyers. And where I think we're a little bit different is we try to stay non-exclusive for a long period of time. So for us, what we want to see buyers do in the second round of the process, about a month long, come make a visit to the company, do some diligence, but really start spending money. So spending money on legal, tech, accounting, and market diligence. And we don't really listen to what people say because all the buyers say the right thing. It's
Mhm.
about how much money are they spending on diligence. And ideally, once we get through that
As a
intensive.
signal for you.
That's right.
Yeah.
That's a
Uh-huh.
that's a strong signal. What they say is great, but what they do is way more important.
Yeah.
And then usually that's about a month-long period of that deep diligence phase. Then we ask for second round bids. And if the process is really aggressive and competitive, we'll also ask them to mark up a purchase agreement. And I just I can't stress how much that changes the dynamic when they submit a marked up purchase agreement with 4 other buyers than if you wait till you're in exclusivity and they send you a purchase agreement.
This podcast is sponsored by Fullscale. Fullscale gives you dedicated senior engineers in the Philippines who are vetted, employed, and supported by Fullscale. They integrate directly with your team so you can move fast and scale in days, not months. They have over 300 active engineers with a 95% retention rate who are trusted by companies across SaaS, fintech, healthcare, and enterprise. Fullscale founder Matt Watson joined us twice on this podcast to talk about his previous practical SaaS founder exits and how AI is changing product development right now. Head to fullscale.io/product-driven for a free copy of his best-selling book, Product Driven, with practical strategies to stop wasting dev cycles and build products customers actually love. Now back to the show. So exclusivity is exclusivity with a buyer. They want to get you in their swim lane. Don't talk to anybody else. Here's an offer. Let's work on it. And then something happens. They want to retrade or play games. You don't have
That's right.
alternatives, right? All that.
That's right. So, and then generally, if the process is run that way and you get marked up purchase agreements, you could be a week away from closing a deal, or you could be 3 to 4 weeks away from closing a deal if you do need to give them a longer period of exclusivity because they haven't done their diligence. But our view is exclusivity is really the negotiation behind the negotiation. It's kind of signifying who has the power. And once you give a buyer exclusivity, things just slow down almost by definition. They're going to take as long as they can because it's kind of an option for them.
Yeah.
And I think what founders
Which
really
is they
don't
don't
understand.
have to buy, but they can play as many games as they want. Yeah.
They can, or, watch to see how the company performs. I think the biggest misperception founders have about this, they're kind of, my word is my bond. So if I sign an LOI, I'm going to do this deal. When buyers signed an LOI, it's really an option to do the deal, right? So they're going to look at a bunch of things and see if it still makes sense. And where I see founders the most upset is when they deal one-on-one with these buyers, give exclusivity early and maybe stay in exclusivity for 60 days, and there's no deal at the end or they did a big retrade. Most of that is their own fault. They just didn't realize it at the time. Like they could have
Yeah.
played their cards differently and probably ended up with a better outcome.
We see that in Practical Founders, the peer groups, 45 founders, and some have gone through this process and, the clapping with the LOI and then the realization that the LOI was just a license to check out their data and see if it's
Right.
still a fit. And so far, none of those LOIs have turned into purchase agreements. And they learned in the process, and now they're
Right.
better there. But yes, so that's really interesting. And due diligence is part of the LOI exclusivity phase, I guess. That's what we hear from founders about how brutal due diligence is and, in this process on the podcast.
Yeah, diligence is certainly painful. Anyone that says it's not is just telling you what you want to hear because they're writing a big check. They're going to do their diligence. What we try to do is get them to do as much diligence outside of exclusivity as possible. So,
Uh-huh.
we've had many deals where all the diligence was done outside of exclusivity. What it means is that they do less diligence because they're competing on timeline.
Yeah.
Sometimes you have to do some of that diligence inside exclusivity. Just depends on how much leverage you have in the process. But the one thing I would quadruple underline is you should never take market diligence risk. So what I mean by that is you should never give a buyer exclusivity and then a buyer come to you 3 weeks in and say, "Oh, we had no idea the TAM was so small or this dynamic in your market." That is work that all buyers can do upfront. The strategics don't really need to do it because they already understand the market, so they've already kind of
I
pre-checked
know.
that box. But if you give a private equity firm exclusivity and they come later and say they didn't like your market, that's seller malpractice is the way I would frame it. Now, if they do some diligence and find out there's a huge legal issue you didn't tell them about, that's an entirely different story. But there's some things the buyers need to do before you even think about giving them exclusivity, and I would put market diligence at the top of that list.
Right. And one of the things that M&A bankers do with founders, the therapy involved, the preparation involved, and so forth, is minimize the surprises, right? Let's get all the stuff out. Let's get it into the data room. Let's get our story clear about that. Let's not get into due diligence and then realize something surprising internally in the business. Is there any way to minimize due diligence by getting your data clean up front, or is it just you got to do both?
Well, I think there actually is. Buyers are humans too, even though they may not seem like it at times. They're humans too. And so they respond to messy data the way you would probably respond to messy work from an employee, right? You really dig
Yeah.
in and try to understand, hey, there's probably more problems here. So the more organized you are and ready to go, the less questions are generated if everything looks the way
Okay.
it should look. And that
Right.
that hits when you say it because it just makes sense, right? If everything
Yeah,
looks
yeah.
organized, you're ready to go. That doesn't mean diligence will be easy. The other thing that we sometimes find is sometimes founders have some things that they're maybe not all that excited to share, and they might
Oh,
hold those.
I
You
know.
should treat your banker just like your lawyer. Let them know about everything up front. We may not disclose everything in the SIP, right? But certainly when we narrow the buyers list down to a manageable group of people, they kind of need to know everything to make that bid worthwhile. And sometimes if you surprise buyers at the end, there can be a problem. Like I'm thinking of a deal we were working on, massive strategic buyer, great buyer, and a deep background issue came out very late in the
Oh,
process that we had no idea about. And with this strategic, that spooked them and they just would not close the deal because they're a
Yeah.
public company and we're going to face a lot of scrutiny. I think if we had disclosed that issue earlier, we
Oh,
might have survived it because it really damaged the founder's credibility. We ended up getting a deal done later with a private equity firm, but you want to know where all the negative things lie. That doesn't mean you want to bring it up right away with buyers. There's a time and a place for everything. Most things are solvable in terms of those things if you manage them the right way. Not always, but most things are solvable.
right. Awesome. Okay, so you've been doing this a long time. You saw the remains of the dot-com bust and the financial crisis, and, the general long, steady climb of, the SaaS game and valuations and exits and funding and all that stuff that climbed, and COVID boomed and then came down and private equity came in, and now we have AI shifting. And last year, growth equity investors and M&A were saying, for practical founders, it isn't so much about AI yet, you know, but this year the game has changed. So let's talk about what's happened
Yeah.
this year. Like literally in the last 6 months, it is shifted. It hasn't stopped, but there's been some really hard shifts that founders should know about. And, maybe they'll shift again at some point, but you got your finger on the pulse here. Let's talk about some of the
Yeah.
shifts in buyers, I guess you'd say. Well, what they want, what they expect, what they're looking for, how they think about AI, threats and opportunities. We just go through a
Yeah,
bunch of those and say
absolutely.
what's changed this year?
It's really interesting because for the last 10 years, if we called any private equity or strategic buyer and said, what makes a good SaaS company? That hasn't really changed that much. Like every buyer will have their own unique take, but it's kind of largely been the
So
same thing,
their
right?
takes haven't changed, right?
Their
Some
takes
want more
haven't changed,
profit, some want more growth, all that. Yeah.
That's right. But in general, everyone's looking for growth and retention as the most important metrics. Then you get into things like unit economics, TAM, but it's kind of always been the same rubric for what makes a good SaaS business. For the first time this year, things changed and they changed so quickly. I've never had conversations like this. Like literally we would talk to leading private equity firms, call it February 1st. Our criteria has changed a lot. It's X. And then the next week, it's X plus Y. And then it's X plus Y plus Z. So we've kind of gotten to a steady state. But here's the crux of it. Growth has always been important. So growth is always a primary valuation indicator because you're buying a smaller company and you care about what that company is going to be like in 3 to 5 years when you exit. Or if you're a strategic, what's the revenue going to be in 3 to 5 years? So growth has always remained important. The first big change we've seen is the maniacal focus on gross revenue, gross retention. So there's retention metrics, net, gross, and logo. I would argue over the past 10 years, net retention has been a little bit more of a focus. So net is just kind of looking at the customers you had last year, what's their revenue this year versus last year on a year-over-year basis. The gross revenue retention metric is really you don't get credit for upsides. It's the same revenue metric, but you get dinged for downsells and churns with no credit for upside. And so you might ask, well, why
Which
are
is
they?
kind of like the bare metal revenue retention, right?
That's right.
Which if you upsell them more seats, more upgrades, whatever, expansion, that's not counted. It's just how many of the customers who paid you last year and are paying you more or less, downgrades as part of that, and how many are around. So it's kind of in between logo and net revenue retention, something like that. But
That's right. Yeah,
that's interesting.
it's kind of a negative metric, negative outlook, right? It's basically if you can't upsell anymore, what's going to happen to your business? And my view on the reason why this has become so important, and largely they want a number around 90% now. So that's kind of like a benchmark for them is 90. And our read of that is it's a little bit of a proxy for we don't really understand the AI threat yet and how it portrays itself with all these businesses. But we know if a business has 90% plus on the gross retention, it's probably pretty resilient and we can take some hits on the AI side and still survive. So it's kind of a proxy for AI risk. The other thing I would say that we're seeing is system of record has become more important. So things that are more point solution like feel like they could be at further risk from AI versus if you're a system of record and really that's a proxy for usage, how much are people using the product and how critical? Then we kind of move into some of the AI risk factors. So what buyers would like to see is system of record, where there's either a data moat, and I would say a real data moat. A lot of companies think they have a data moat, but they don't really have
Yeah.
a data moat. Like you can, go get this data from other places. So proprietary data or a payments opportunity. So usually businesses that have payments are a little bit more resistant, and that's viewed as kind of a moat around AI. And then if it's not agentic, and let's be honest, if your business started 8 years ago, it's kind of hard for it to be fully agentic. You need to work towards agentic or at least have the ability to kind of hang agents off the backbone of your software to go provide value. So those are generally the things that we're seeing that are driving what a good company is versus last year. In certain sectors, mid 80s gross retention was still really good, particularly if it was a business that had a lot of SMB customers. What's interesting is all the software companies we talk to are still doing great. Like their growth rates haven't come down yet because of any AI risks. Actually, their costs tend to be going down a little bit because
Yes.
they're
Yes.
implementing AI.
Yeah.
And the one thing that I think is missed in all of this, and I would really encourage founders to think about this, even older than you and I, Greg. So we weren't really part of this, but there used to just be IT services. There wasn't a lot of software. So that was
Mhm.
someone doing a service for a business. Then the SaaS founders got smart and said, well, we're just going to provide software, which is really high gross margin. We're not going to do the messy services stuff because
Yeah.
there's a lot of people involved in that. And that was the right call because those businesses traded at much higher multiples. But as much as the software TAMs could be impacted by AI, so you might be able to charge a bit less for your business. Now these services opportunities open up because you can use
Yeah.
AI to go provide this IT, well, it used to be an IT service, but you can do it at a really good margin. So the reason why I'm so bullish going forward is I firmly believe the TAM of software plus these services you can now provide is bigger than your original SaaS TAM. And that's the exciting thing. So we have some cool businesses we're working with right now that, if you looked at their website, they look a little bit more servicey, but they are heavy AI consumers and they're delivering that service at software like gross margins. That really gets people excited around the future of SaaS plus services.
Right. And all this AI capital expense spend that's going in, the trillions, right, isn't just about selling more software on top of humans. It's adding labor, doing labor at lower margins, getting things done out there, including services or sometimes replacing what you didn't do with employees because it was too expensive or replacing some employees. Well, there's a whole bunch of things in there. Well, I'm talking to practical founders about this all the time here. Would you say that revenue multiples have moved or they've bifurcated these growing sticky systems of record in verticals with proprietary data and let's say agent opportunities, right? That maybe they're starting to tap away. Are they getting higher valuations? And then there's the crowd of horizontal point solutions, lower growth, I'm is it really bifurcated these days or is there a
The way we tend to think about it, and this is frankly more of a continuation of a theme we've seen the past 7 or 8 years, is the aperture is just shrinking. So if you're in the aperture of the investor and buyer's sweet spot, the valuations are as high or higher. If
Okay.
you start to
All right.
fall out of that aperture, that's when the valuations fall off. So just to give you a corollary, if you remember, early part of COVID, it was all about the sector you're in. So, for example, I remember we were getting ready to launch a travel deal right when the COVID ban happened. Travel was dead for a while.
Yeah.
EdTech did really well when
Yeah,
when
yeah.
we were
Yeah.
shutting all the schools down. So there was this kind of weird thing within software where you were at in the COVID ban. And then, of course, as we started to come out of COVID, travel just ripped and it was an
Yeah.
amazing vertical and EdTech kind of fell back a little bit. Then we had the interest rate increase due to inflation. And so that really put the brakes on all these low or I'd say not good unit economics businesses. So if
Right.
you were really unprofitable, suddenly your valuation was terrible. Fortunately for us, all of our companies are break even or a lot better. Those valuations started ascending because it seemed like this, the safe asset. So you had this aperture shrinking. Now AI is added on to that, and it's probably been the biggest shrinker, if you will, in terms of that aperture. So I would say if you don't have a good AI story, if you don't kind of fit into the box I described earlier, your valuations might be down 30%. if you cleanly fit in that story, your valuations might be up 30% and everyone's
Okay.
all over you. So I think that's kind of the way to think about it. And the other thing I would just say is there are some deals that, and we have to give this advice a lot right now, that last year would have been really good deals that are not transactable right now because or the discount would be too high. The
Mm.
other thing I would just say, this is all
And
mainly.
why is that, Mike? What are the characteristics of something like that shifted?
Yeah, I think it's just that the buyers are so nervous about businesses that fall below those retention metrics and they feel like they're particularly at risk of AI that they don't want to go deploy capital and look
So
dumb
the
later.
retention below 80%, without
Absolutely.
a clear story around that.
Without a clear story and if it's viewed as particularly at risk for AI, because there's already been so much money invested in software. And, what I hear from the PE firms is that their investors are saying, we want to be light on SaaS right now. So it's got to be, really good SaaS. And it kind of depends on their fund's performance. If they haven't done well, they're definitely going to shy away. The one thing I would say that feels like it's permanently changed is horizontal software, to me, feels permanently challenged because it's at such a risk of AI because there's such a lack of specialization in that software. And we generally don't work with those businesses anyway because they've had to raise a lot of capital. But that is the part of the market that feels like it might be permanently changed.
Well, there's something in between real verticals, the system of record for auto shops or whatever it is, and big horizontals like Salesforce CRM. I played that game for a long time. There's niche horizontals, right, that are
Hmm.
not just a feature add-on for the big horizontal products, but and they're not really industry specific. Maybe they're a little multi-industry, not all industry, something like that. Are those still at risk there if it's not literally industry specific? And
I think it depends a little bit on how big the TAM is. So you're looking for that sweet spot where the TAM's big enough to build a good business, but not so big that, some frontier model's
yeah,
eventually going to get there. And just the specialization that's in that software and how specialized is it is kind of
yeah,
our view for looking
okay,
for
fair enough.
defensibility there.
Yeah. What can you say generally about buyers this year? We have the SaaS
Yeah,
apocalypse in the public markets, right? And VCs have moved on to AI first rocket rides.
right.
And a lot of the cool kids, the unicorns that raised big funding during COVID are kind of stuck now unless they've got a new AI conversion story. But I'm seeing practical founders leveraging AI, moving faster, and coming into the systems of record vertical that are still hot and other. But like, are buyers out there buying in this bootstrapped lower mid market or whatever we'd call it? Like, there's still a lot going on, isn't there?
There's still a fair amount going on. I would say everything is just a little more tepid. So what we're seeing in our
Okay.
deals is, I would say, less bids in the first round than the last few years. So if we were getting 15 or 20, maybe it's 10 or 7
Okay.
to 10. So I would say less first round bids. And then where I really see it is the pull through on second round. So we're seeing less folks get to the finish line. So let's say you bring 7 forward, maybe 2 or 3 make it to the finish line and want to do a deal rather than 5 or 6. And I would say that our evidence is people are looking for reasons not to close a deal right now. So they're nervous
Yeah.
about a lot of things.
Sitting on their
And so
hands,
they're a
getting a lot of
little.
questions. Yeah.
Lots of questions, and sometimes you might have a buyer who did a fair amount of diligence but still pull out in the end, and you felt
Mm.
like they just didn't want to deploy capital. Like the IC just did not want to deploy capital. You don't see that as much on the strategic side. I mean, they're already in the industry. The beauty about strategics is they're in the industry, they're living it. They're just looking for a way to, grow their business the most effectively. For an investor, they can just choose not to do that deal and do a totally different deal. So
Yeah.
I think we're, without giving away numbers, at the margin, we're probably pulling slightly more bidders through to the second round than we would in the first round because we expect a little bit more fall off. And in general, buyers are a little bit less willing to spend money on the really expensive diligence outside of exclusivity, but we still push that angle as much as we can.
So you talk about strategics, which we think about Google, Microsoft, and they used to buy companies in the old days, big public companies, I think you'd say. But there's private equity owned strategics, especially in verticals, right? Does this mean that you're selling to a strategic? It's private equity backed, so it has a point of view and
Right.
funding another funding decision maker in there. But are these tuck-ins that come in, the add-ons to fill in a platform, or are they adding new platforms, or how do you describe that?
Absolutely. We see, over the past 10 years, that's the part of the SaaS M&A market that has changed the most. So, if we were talking 10 years ago and you said, I just want to maximize valuation, we'd say, oh, well, it'll obviously be a strategic buy. It will
Yes.
never
Yeah.
be a private equity company. Now, you actually see the private equity standalone deals. So that's where they don't already own a platform. And really, the private equity-backed strategics being huge players. And the reason why is, they're looking to grow those businesses very rapidly so they can get public. And the other thing, and this is something I would just point out to founders as they're evaluating inbound interest, if you have a public company that's trading at 4 times revenue, it's very unlikely they're going to pay you 15 times revenue unless they just have to have the business. And as many times as my clients have said, hey, strategic X has to have me, that's like a 1% of the time kind of thing. It's not all
Yeah.
the time they have to have you. A lot of these private equity-backed strategics were bought at high multiples. So their quality of businesses that trade at 8 to 15 times revenue, they're much more likely to be able to pay you a good multiple
Yeah.
and also maybe give you some upside along the way because your business as a proportion of the combined business could be somewhat material. But,
Yeah.
if Google buys you, you're a 0.5% of their business, right? It's just not that big of a driver.
Back to the that retention metric, the gross retention, the hardest measure in there,
Hmm.
gross revenue retention, you would say. That is a sign of product market fit, meaning you're not selling to bad customers still
Right.
and shoving it in and experimenting. You have reached product market fit and you've let the other ones drift off who weren't product market fit, right? Which
That's right.
happens. So most software companies know where their product market fit green zone is, and they
Right.
also know where the reds, the small businesses they sold to before they went up market and got stickier. How does that discussion happen in M&A? Can you tell a story about the core and the previous and distinguish, or are they
Yeah.
all looking at the total average?
So this is an area where we spend a lot of time in that prep phase. And generally, the story is exactly what you said, right?
Okay.
Founder started the business. Instead of raising money, they kind of sold to some of these smaller clients that are easier to
Yeah.
convert. The smaller the client, they almost always have worse retention. That's always the case.
Yeah.
So what we try to do is try and marry the ICP that the business is feeling. So who are you focused on with the data? And so a lot of times we'll cut the data many different ways, and we try to cut out maybe 10 to 15% of the revenue. That's usually the amount of those small customers. That could be based on the size. It could be based on some usage metric. It could be based on many different things. But usually the rule is if you can encompass 80% of the revenue of the business and
Okay.
show really good retention, that will usually work its way through diligence. Okay, if you're down to 60%, no way. They're just going to kind of get rid of the rest of the revenue and value on that 60%. But what we find with founder-led businesses, there's constantly this pattern where there's these smaller customers or lower usage customers. The other thing I would say, and I've had this conversation with many founders, I bet if you actually went and calculated your margin, because usually these small customers take up a lot of time or kind of a pain in the butt, for lack of a better term, I bet you're actually losing money on these guys, but you don't really know it. So yeah, a lot of work there trying to understand the ICP. And it's really about trying to frame the future opportunity largely for a private equity firm. Because remember, their thought process for most of these businesses is it's a great product market fit. I'm not going to invest in it if it's not anyway, because I don't know how to fix that. What I am good at is scaling sales and marketing. And so I need to understand what that ICP is and frankly, how big the addressable market is to make sure I can deploy my sales and marketing dollars to go help this company get a big return. And I would say that's the sweet spot for why a founder would do a private equity deal over a full strategic deal, because they maintain a lot of that upside in a private
Yes.
equity deal if they believe they can go execute on that.
Right. They get a piece of the next growth spurt in the business. So you have to believe there's a growth spurt in there that you weren't able to capitalize on, right? And that's a little bit of the agreement that's going on here. I'm interviewing somebody tomorrow who's, the leader, CEO of the businesses that private equity buys after the founder leaves.
Hmm.
And he's not very convinced that any founder can stick around very long in private equity, this transition, right? What about, the CEO role in these deals? That's another term in the negotiation, not just
Right.
valuation and majority minority percentages. But how should CEO founders think about their role when they sell to private equity? They don't get to go away. They probably have to run it for a while. Or, how should, what's an expectation range
It,
that
it,
is useful for them?
it's a great question. And it's another reason we think about running a broad process because our experience is founders are going to change their mind based on who the prevailing party is about what they want to do, right? That
Yeah.
just makes sense. And so I would say there's a whole spectrum of PE firms. There's certainly some PE firms out there. I won't name them, but it's probably pretty easy to figure out who they are. Who their preference is actually to swap out senior management because they have a playbook they want to run, and they know
Hmm.
founders are resistant to playbooks, and they have people they've ran the playbook with before. There are some private equity firms that really only want to invest in the business if the founder is going to stick around. So I
So
think
that
what
range, like there's a range across there.
there's a
Yeah.
range, yeah, and there's
Yeah.
kinda all
Okay.
points in between, and it's gonna be trade-offs with other deal points. But in general, I think what a founder should be open to is sticking around somewhere between 6 to 12 months, but being open to sticking around longer if it's going well. But there's a little bit of a trick here is sometimes when founders communicate their interest to leave, what the investor hears is, "Oh, there's not a lot of upside left in the business." That's why they
When they're
wanna leave.
saying, "Yes, I wanna sell the company, but I don't wanna stay around very long,"
Yeah.
right? Yeah, I see.
So there's a way you go about talking about how excited you are about the upside of the business and the upside you believe in the business, but maybe where your role, like for some of our clients, they're better product people than, they don't want to go run a big
Oh,
sales and
sure.
marketing
Very
organization.
common.
But I
Mhm.
think generally founders coming into it with an open mind and being open to all the potential outcomes, but then you get to decide in the end. So, for example, let's say you really wanted to exit at close. We might end up picking a deal that's 5-10% less in valuation, but maybe
Yeah,
it's
it's
a
a part of
strategic buyer where you can leave. But you should be open to all those options, if frankly, if for no other sake than to have the leverage in the negotiation to kind of get all the things that you want. Usually there's options available. I've seen some founders do fantastic with being the CEO and running it through the next exit. I've seen some really struggle. The one caveat I would just say, and I don't think founders realize this, if you get a really premium outcome on your deal, so let's say we run this hyper competitive process and you get a crazy high multiple,
Yeah.
that means the PE firm has priced this to perfection. So there's a lot of pressure to execute from day one because if things don't go well, they're not going to get their IRR. So the most stressful situations, ironically, are the best companies who have performed the best and we've gotten the best outcome because now the PE firm's under the gun to grow the business to kind of get their return. And so that's something I think founders don't necessarily understand a lot as well.
Yeah, that's right. Another thing founders don't understand is the different kinds of buyers out there, right? Used to be just sell the strategics or go public. That was the
Right.
old days. And now there's private equity. And the first one that showed up were the buyout firms that would put debt on and
Right.
raise prices and do all that, not fun stuff, right, on a legacy business. But there's all kinds of ones in between. The buy and hold guys are showing up and they want the founders to run it or
Hmm.
the replacement CEO to run it as an
Right.
independent company that spits out profit. And now we have Bending Spoons that just went public on the other side of the pond that's doing a version of that. And then you have growth-oriented private equities, not just this extractive private equity
Right.
out there. What flavors, are those the right flavors these days, or did I miss anything?
I think those are the right flavors, and it really boils down to what the founder wants to do. I tend to think about the universe from a founder perspective, and the way we advise founders to think about it is through liquidity, control, and upside. There's other interests founders have, but those tend to be very common. With the old school strategic deal, in theory, you're getting the most liquidity, right? Because you're generally selling
Cash
100%
out.
of the
Yeah.
company. And it doesn't really make sense to take equity in a public company. You could go buy the equity if you wanted
Yeah.
to, right? It's not any special access to that equity. With the advent of growth equity, private equity, this kind of exiting in stages concept works where you may not get the most amount of liquidity, but you can have more control and certainly upside. And so one of the things founders tend to think about is it's all or nothing. I'm either selling the whole thing or I'm not. With all these other types of buyers, you get this concept of exiting in stages. And what it can allow you to do is de-risk along the way. So you might be able to take 30, 40, 50, $100 million off the table in the first deal, but you might still have significant upside left in the business if things go well. And I think that's the one thing founders don't really think about. They think about it as an all or nothing proposition and that, I'm selling the business. I would say founders also tend to not give the rollover equity much value because if they do a majority deal, they're not in control. So, obviously they're worried about the new owners going to mess up the business. But I think they tend to devalue the rollover equity quite a bit in a way that, frankly, we don't, based on what we've seen happen with a lot of these companies.
Yeah, this was the old days that if you did a partial sale and you still own part of it or you had an earn out or whatever, the earn out was always like, well, you're not going to get that.
You're not getting that. Yeah.
That was the old days. But now this is like a buyout. They buy 60% of your company, which means you still own the 40%. And if you bring in a CEO and there's a new management team, I've had just a few on the podcast here recently, you're the majority, you're the biggest shareholder in the company. You're on the board, but you're not running the company anymore. And if the company is growing 40%, 40%, 40%, 40%, you'll make more on the second bite of the apple than the first bite. It's very different than the old days. And more than half of the founders who've sold their company to private equity on the podcast here that I've interviewed have done equally as well or better on the second bite, right?
Yep.
They left enough meat on the bone for the private equity and helped out and chose the right partner that would not, kill it. And that's pretty exciting possibility. It's not as clean as it used to be, you might say. I'm out. And then founder would be on the beach the next day or something like that. But something that they deal with. Is that about your experience that in general, founders are getting a pretty good second bite?
I think in general, it certainly depends. Again, back to this point, if you price the deal for perfection and you get a really high multiple, it's actually a little harder, right? Because you're starting off a higher base. It depends on the sector and the vertical and just how the company performs. But in general, I think most founders are happy they de-risked early because if the business performs poorly, you're glad you de-risk some, right? The other alternative would be not de-risking at all. So in general, I think founders have done pretty well. It's kind of vintage-based. Like I would imagine founders who got liquidity 2021 might be harder to get a good return on that rollover equity because it was priced so high. But the part of you that sold the 60% is really glad you locked in that high price in 2021 for that portion of your equity.
Does this depend on the backlog that we read about in the Wall Street Journal that private equity software companies are piling up? They've acquired all these and they're not exiting them. At this level, this size, slower to exit. It's no longer 3 to 5 years. It's 7 to 10 years. You got to hold these damn software companies to grow them big enough to sell them. Are the second bites slowing down now just because of the backlog?
I think the second bites are definitely slowing down because typically that's a bigger company that is more subject to the things that are going on with the larger IPOs and exits. I think that's where the bigger the software company, I think the slower it is to exit. At some of these lower middle market deals, I still think there's still funds who can deploy capital and want to do those deals because that hold time is going to be, 5 to 6 years. But I would say there's more scrutiny on those deals to understand what the exit's going to look like for sure.
Does a founder ever get through this unscathed? It's emotionally challenging to go through this and due diligence and sell your baby and deal with buyers and strategics and maybe a pile of cash is disruptive as well. How do you offer therapy to founders to get through it? It is one of the benefits of having an M&A banker versus you and Claude and your little lawyer, who isn't much advice on the process. But how do you help founders go through this process?
Yeah, I think the first thing we try to do is the way we structure the competitive process is to cut out a lot of the nonsense that founders experience on their own. So, I signed an LOI for 60 days. I sat in exclusivity. They put me through a ton of work on diligence. And then they retraded me at the last hour. There is some stuff that is just going to be painful and tortuous, which is diligence is not going to be fun. It never is. And if they're writing a $100 million check, what diligence would you do if you were writing a $100 million check? But I think what you want to do is you want to run this process to get an outcome. You don't want to mess around and not get a deal done and be distracted by it. So I think you want to do it the right way and maximize the chance for a really good outcome. I also think sometimes founders get really upset at the M&A game the buyer is playing. So I'll give you
Yeah.
a really good example. Let's say you sign an LOI and you don't have a purchase agreement yet. We know that purchase agreement's going to come back super buyer favorable. Doesn't make us angry in the least sense. Our lawyer knows it's going to happen and we're going to negotiate it back. But, founders get really upset about that because they feel like they're moving the goalposts on them. So I think there's an element of game to this that can really upset founders who just want to be efficient. They just want to get to a close. And then there's always things that are going to pop up that can easily be misconstrued by what the buyer's intentions are. Like, I'll give you a really good example. Usually the buyer does not spend a lot of money on tax advice early in the process because tax advice is really expensive. Our clients who are very nervous about how much taxes they're going to pay are all over this topic, right? So we have tax advisors lined up. We're modeling things out from day one. Is a
For
buyer
the
going to
founders.
put,
Yeah.
yeah, for the founder, sorry, for the founders. Is a buyer going to throw some tax language in the purchase agreement they didn't fully think through because, it was in their last deal? Yes. Is that going to be bad for us? Yes. Is it going to end up that way? No, it's not going to end up that way, right? The tax things are too much. So there's just, I think, lots of things they misinterpret and just don't understand the game that's happening or the restrictions that's happening with the buyers. And so just being able to explain that in a way and kind of see around the corner, that's our job, is to kind of know what's coming, know where we're headed, and try and head off as many of those things. And I think founders, it's just such an emotional process. Like what I tell founders is, I think we do a really good job of managing your workload and taking a lot of things off your plate. I've yet to figure out how to manage the emotion of the process really effectively because it's really important. And the last 3 weeks of the deal, you're going to be hyper nervous. Like one of the stories that highlights this the most, we were selling a company right around the time the election where Trump got elected the first time. And our client decided to pick a Chinese buyer over like a really solid U.S. buyer. It's basically the same deal. And we wanted to go with the U.S. buyer because we knew they would close. So we had to get like some approvals like HSR and CFIUS. And that was during the boom time in M&A. So we didn't think it would happen before the end of the year. Well, these approvals came really early and we were going to be able to close. But in the interim, Trump had just won the election. And our client said, hey, I think capital gains rates might go down next year. Can we just close next year instead of this year? And we said, strong advice, do not do that. You always close a deal you can close. And by the way, tax rates usually don't change in the first year. So anyway, he didn't take our advice. So we went forward. That January was the January that China decided to shut down all capital outflows out of China. So 4 days before the deal was supposed to close, we weren't hearing anything from their lawyers. So we knew there was a problem. And we also knew about this capital outflow. So we had a meeting with them in early January where we were like, show us the money you have to close the deal in the account. And they wouldn't show it to us. In that interim, our clients started having these massive health problems, all stress induced, right?
Yes.
Fortunately, there was a way that the founder of that company in China got a loan in the U.S. and we closed the deal here, in mid-January. But that was about 25 days of torture for our client that was entirely self-imposed. And so you can't get that stress level back. But that's kind of like the extreme example of just the stress of this. And it's really the stress of once you have a deal you want to do, basically nothing good happens until the day that it closes, right? Everything else is just diligence. So once you have a deal you want to do, you want to close it as soon as possible because everything else is bad in between.
Right. And it's never closed till it's closed. And don't forget your other business, and stuff happens, as you say. If you had a billboard here for practical founders who are thinking about shopping their company and not aware of all the misconceptions they have about this, but in order for them to have a successful exit, right? All things considered, what is the biggest misconception you would clear up on a billboard that, you want everybody to see about this process that practical founders out here should hear about?
I think the biggest conception, and we hear this constantly, is, tons of people are interested in buying my business. And then, the question is, well, why? Well, I'm hearing from these private equity firms constantly. So all this inbound interest does not mean they're necessarily interested. A bid does not mean they're necessarily interested unless they've done the requisite work to understand. So there's a private equity firm in particular that every time we market a deal, they ask for exclusivity right away and they want to bid. And we're like, how can you bid when you don't have the information to bid. Like, we know what you need to be able to produce a high quality bid, and you don't have that. So I think there's this sense that because people are calling you, and it's even worse now with all the ability to use
Oh, sure.
AI to write emails,
Hmm.
you need to
Yeah.
understand who the buyer is, if they're credible. Are they a premium buyer? Are they a cheap buyer? Are they going to retrade you? Like, who are they? And most of the times, like, we'll just have a founder adamant that he has a lot of interest, and then we hear who it is finally, and we're like, oh, we wouldn't even talk to them. Like, that they're a total waste of time, or they're going to
That's
bid
their game. That's how they play. Yeah.
that's their game, or that's just who they are. And sometimes it's different. Like, you may have a firm that bids poorly on a high growth, really sexy software business. But if you're low growth, old tech, a lot of EBITDA, they're actually a great buyer. Like, they're going to be one of the premium bidders for that asset. So it's kind of knowing who you're dealing with. And again, the last thing I would say is pay attention to what people do, not what they say. So if they start spending money on diligence, we're paying attention. If they spend $500,000 on diligence, I think you probably want to do this deal. If you're, doing a bunch of calls with the founder and trying to get data, you could just be trying to get smart on the industry. And those are really different things.
Yes, we hear a lot about that here. Mike, thanks for sharing all that. Do you have any other typical advice for practical founders that they should hear about how to think about this game if they're ever going to go through it?
I think, in theory, people make really rational decisions around when they want to sell their business based on market timing or what's going on with the business. I actually find founders make decisions based on what's going on with them. So, typically, it's some frame of the business has gotten bigger. I'm spending a lot of time on HR. I don't really enjoy that anymore. So,
Yeah.
I think knowing what your core interests are is really important before a process, and not, no one ever really times it that well, even though we talked about it a lot. It's more about what's going on with them. And the last thing I would say is, being prepared for this process is really important. And the biggest red flag we hear when we're talking to founders is, oh, we're so buttoned up, you won't believe it. Now, maybe if you've raised $10 million from like a smaller VC, that might be the case. But usually it's a lack of knowledge that leads to the, oh, we're so prepared and we're ready to go. Usually you're not. And if you haven't raised money before, you shouldn't be, because all the things that buyers
Yeah.
care about, you don't really care about managing a business day to day for the most part.
And you help them get through that and make sure that things get buttoned up.
That's a big part of the process up front, is being buttoned up and being presentable to buyers so that you look like a premium asset.
And that doesn't happen overnight. So, how can people engage with you and your team members to say, can we have a conversation about what I'm hearing as a founder and what I'm thinking as a founder and what you're seeing as an M&A bank? And what should I start working on before cleaning up and fixing before, we have a partnership and take this thing to market? How do they engage with you?
Absolutely. Yeah, there's some easy things you can do that are more like the documentation, so the paperwork, and those are pretty straightforward, and we can help you walk through that. But I think the really valuable thing, particularly for a founder who doesn't know when is the right time to exit, is we do a lot of benchmarking analysis for companies. So we'll take the data that, by the way, every PE firm or strategist can ask you for upfront, that revenue by customer data. That's what everyone wants in the
Yeah,
P&L. And we'll run all the benchmarking analysis. And if you're a year away from an exit, we can say, these are the factors that will most impact your valuation a year from now. Is there a way to improve those? Or these are the factors that are a no-go right now. Like, this will limit your ability to get a deal done or crush your valuation. So I think understanding exactly how you're going to be graded and what the weak points are is very important. Like, I'll give you a good example. Sometimes you run across some of these small businesses that are growing really fast, but they have a 40% customer. And they've locked them into a
Yeah,
3-year
classic.
deal, so they feel good about that. They just don't realize that buyers generally are going to discount that heavily or not do that deal at all. So you'd
Yeah.
be, every dollar you add in that customer is way more valuable than adding a dollar from that customer. Or let's say your net revenue retention looks pretty good, but your gross is suffering, and we could tweak that ICP that you're going after up front. That would also be really good. So there's just some things that are going to have big impacts on the interest level up front from buyers, and that is a direct correlation to the valuation you get, that you want to understand that. So we spend a lot of time doing this benchmarking analysis. And
Is
there's
that
some
before a founder engages with VistaPoint advisors and your team members? You can give them, it's a relationship building. You're going to benchmark them. You're going to give them some perspective, or is that
yeah.
audit? Yeah.
No, that's pre-engagement, and, to be candid, we use it as kind of a business development tool, right? We get to know your business really well,
Sure. Yeah.
so if
Right.
you come to
Yeah.
market a year later, we know it better than everyone else, but it's really a help founders understand is now the time to go or not. I think one of the problems you run into with bankers is, the joke is every banker will tell you now is a good time to sell your
Yeah.
business, right? Because that's what they do, right? They sell businesses. We kind of take the approach a little bit more of, we'd like to work with you, but we might really like to work with you 12 months from now because we think it's going to be a much more competitive process. So yeah, it's basically signing an NDA, giving us some data, and we can turn that around pretty quickly. And it just helps you kind of have a compass for where you're going. And if there's things you don't need to work on, that's great. If there's things you do need to work on, you can spend some time on that and hopefully move the needle on valuation.
And what if somebody is getting bites and they've had enough, whether it's the right time or not, right, as you described, and it's time to go? How quickly can they spool up a process when they say it's time, right?
Yeah, it kind of depends on the quality of the inbound interest. So every once in a while, there's some really good inbound interest, and for lack of a better term, we have to boogie. And
Yeah.
so in those situations, you go to market a little bit earlier, maybe in a week or two, with
Wow.
limited data, and you are taking some additional diligence risk in that situation.
On your
About
side. Yeah.
n-
Yeah.
yeah, about
Yeah.
90% of the time, or 95% of the time, that buyer interest isn't that good. And we say, let's do the normal process. Those guys are going to be there when we want to launch anyway. But frankly, we're not losing that much because they're not premium bidders. But in the situation where you have a really good buyer, you still want to create leverage with them, and you want to get what you're trying to do is get 3 to 4 highly interested parties at the end to negotiate against each other. And so you're just going to have to include fewer and take a little bit more risk, but it might be worth it depending on the situation.
Okay. So sometimes that helps. I appreciate that. Well, Mike, thanks again for being on the Practical Founders podcast and helping so many practical founders out there, achieve their dreams. It's a difficult game to to build a valuable software company without big funding. And a lot of founders think of the exit as the one of the big prizes at the end. So thanks for helping so many practical bootstrapped software founders get to the end of the rainbow.
Absolutely. And thanks for all your work to educate founders on the other path, right? Not the heavily VC'd path, give up all your company and have no economics at the end. I would say that most of our founders, obviously there's notable exceptions with really big companies, right? But I feel
Hmm.
like most of our founders in the end do better than the ones who, give away all the
Yeah.
companies to the VCs and work really hard for a long time and frankly not even understand the economics in their business that they own. But, if you own 70% of your business, you know what you own. And so it's great working with founders. I like to say it's probably more stressful than working for,
Yes.
PE-backed companies who have professional CEOs, but it's definitely rewarding. And it's fun leveling the playing field against the investors and the buyers because obviously they're super sophisticated in how they do M&A. So it's fun leveling the playing field a little bit.
Awesome. Thanks again, Mike.
Thanks, Greg.
Thanks for watching this week's interview on the Practical Founders podcast. Be sure to like this episode and subscribe to the Practical Founders YouTube channel to keep up with my weekly in-depth interviews with serious software founders who are building valuable software companies without big funding. You can check out my blog, all the podcast episodes, and information about my Practical Founders CEO peer groups at practicalfounders.com, or message me on LinkedIn if you'd like to connect. See you next week.